I think we should start because we have an outer time limit of 7 o'clock, and sometimes the discussion on our forum can become very interesting and go on. And it's more of an academic, come a policymaker, come a central banker forum. So all types of students also join us. So we are a very wide spectrum, and as we go on, people will keep joining. Also, because the recording is available, even after the event is over, we get many hits on our webpage for the recording. So if I have your permission, let us start then. So today, I am very happy to introduce Professor Hans Genberg, who is joining us lecture. And Professor Hansberg is very well known in areas of international economics. He has been a professor of economics for nearly 30 years. And out of that, he was head of the economics department for nearly a decade at the Graduate Institute of International Studies in Geneva, Switzerland. He holds a PhD from the University of Chicago. For me, it's a dream place to be in. He has worked at the IMF, and he has also been working at the Southeast Asian Central Bank Research and Training Center. And right now, he is the professor of economics at the Asia School of Business and is senior director of banking and finance programs. Before this, he was at the International Monetary Fund at the Independent Evaluation Office of the IMF, and I have known him since then and have been in touch with him and seen his scholarly work. Right now, he is doing something which is very interesting. He is developing a course program for a year on central banking. And if he has time, I'm going to request him to spend a minute or two to tell us what that interesting program is all about. In India, we had come out with a report on currency and finance about 15 years back, focused on central banking. And Dr. Rakesh Moore was instrumental, and I had done some editing, and therefore I had done lots of work there on it. And now when he told me that he is developing this program, I thought that's very interesting. Central banking is very complex and sophisticated, and really a professor and a graduate from University of Chicago, I think, is the right person to be developing that course. So welcome to Professor Hans Genberg. Today's session is being chaired by Dr. Arvind Virmani. He is the chairman of the Foundation for Economic Growth and Welfare, and most of the research activities and all initiatives that we take under his guidance. He is chairing the session today, and I'll hand over the session to Dr. Arvind Virmani, and then we go over to Professor Hans Genberg. Dr. Virmani, please.
Thank you, Professor Charan Singh. It's really, we are fortunate to have Professor Genberg speaking to us. And as you already introduced him, let me straight away ask him to start speaking, and then maybe I will pick up a few of the themes after he is spoken to start the before the Q&A session. So, Professor, please.
Thank you very much, Dr. Virmani. Thank you, Sharan. It's a great pleasure to be speaking to you. I was going to say this evening, but this evening here in Kuala Lumpur is late afternoon in Delhi. So it is a great pleasure to be with you. I'm going to share with you my screen because I'm going to speak off of some PowerPoint slides that I would like to share with you. Okay, now let's make sure this works. Can you see the screen? The central banks and COVID-19 text. Very good. So the topic then that I will want to speak on tonight is that one, the central banks and how they should be acting in the context of the COVID-19 pandemic. And I want to talk about three issues. And as an introduction to the main topic, I want to talk about the nature of the COVID-19 recession, because that will indicate how central banks should react and why they have reacted the way they've done. And then I'll talk some about what central banks can do to help mitigate the recession, and something about the potential risks. Now, what is the nature of the COVID recession? In particular, is it a demand shock or a supply shock? And my answer is that it's some of both. And let me explain, first of all, what they are, and then argue why it's the current recession is some of both. It's a supply shock because, at least initially, but that lingers on in many jurisdictions, there was a decrease in economic activity because of various degrees of so-called lockdown. Mandated shutdowns of firms, workers were not allowed to come to work, limited opening hours of factories or restaurants, and travel restrictions and so on. And that is certainly lead to a reduction in economic activity from the supply side. There's also a regional, global, and even domestic production chain aspects of this. These production chains rely on inputs from many sources, and to the extent that those inputs are not available because of lockdown in one part of the country or in one part of the world, then assembly in other parts of the world will be disrupted, and that will reduce also both international trade, and it will reduce economic activity worldwide. Of course, there's also a demand shock element to the current malaise. And this is because when workers lose employment and income, they will, of course, reduce their demand for goods and services. There's also their inability and reluctance, frankly, to travel, to go to restaurants, to go to shopping malls, and so on. And that will reduce the demand overall in the economy. On the household side, on the side of firms and enterprises, the uncertainty about the nature of the post-COVID world will lead to an postponement of investment decisions, which will lead to also a decline in demand, overall aggregate demand. It's important to keep these distinctions in mind because the appropriate response depends on the problem we are trying to address, whether it's a supply problem or a demand problem. Now, let me illustrate these two kinds of recessions by some historical facts, or some facts from the United States. The pictures you see are unemployment, changes in unemployment, in number of unemployed people in the labor force in two recessions, the recession 2008 and 9 and the current one. A demand recession is typically a slow motion recession, followed by fall in demand.
Hello.
And it took a year and a half for unemployment claims to go from 2.5 million to 6.5 million in the United States back in 2008-9. In the current recession, it went from 2.5 million to 25 million in 8 weeks. And that is typical of sort of a supply side problem that we have now. And it is like what you might find in a natural disaster when productive facilities are completely destroyed and so on immediately. So it is a little bit like a medically induced coma of the economy. It just stops. And that is what needs to be kept in mind when we think about what central banks and other official agencies can do. Now, how deep is it? And how fast the recovery? This table shows forecasts from the latest World Economic Outlook. And it shows for all of these examples, a very sharp reduction in growth in 2020 compared to 2019. And most of that reduction also came in the first, second and third quarter. So for the world as a whole, for example, it went from 2.8% in 2009 to minus 4.36 in 2020, forecasted for the year. And then IMF forecast it will pick up again quite rapidly and exceed pre-COVID growth rate, at least for a while. And similarly, you know better than I, and you probably certainly know better than the IMF what the projections are for India. However, in this table, it shows a very, very sharp decline in growth rates, followed by a sharp increase in growth thereafter. Now, so that looks like the very sharp increase in growth in 2021 is, of course, a nice feature, and we should hope that it comes about. But we shouldn't be too enamored with that for the following reason. In this chart, I show you, for the world and for India, two types of graph showing this essentially the same underlying data. On the left-hand side, it shows the growth rates, very sharp fall in growth in the world to minus over 4% in 2020 and a 5% growth rate in 2021. It sort of looks like the V-shaped recovery. But if you look at the implied level of GDP, you see that on the right-hand side. It goes down, of course, the reddish line in 2020, and then it starts increasing. But it never, according to the IMF forecast, it never catches up to what they predicted the growth path would be back in 2019, the blue line. That's what they thought before the COVID hit, that what the growth would be in the world. And now we are facing a situation where we will be permanently below. Same for India. Even though the growth rate projected for 2021 is it's close to 9%, we will never, according to those forecasts, catch up to where we would have been. And that has a number of implications for central bank, for how we should look at the economy going forward. Because investment plans and other plans were based back in 2019 on the blue line. And now we are facing a situation that looks more like the red line. And maybe as a result, those investment plans that were financed in banks and other means, they are now not as productive, and we might see some corresponding problems. So, and the same is true in virtually every other economy that the IMF does projections for. We don't seem to be catching up to pre-COVID growth level of GDP paths. Of course, we should remember that these are forecasts, and outcomes may be different, and outcomes probably will also depend on how the crisis is managed in various countries. But we should keep in mind that recently there has been a lot of economic research which suggests that recoveries after financial crises and deep recessions lead to very long-lived shortfalls in GDP and economic activity relative to what one expected before the financial crisis or the deep recession. Here there are examples from the financial crisis in Asia in 1998. There's that crisis in 1980s in Latin America, similar patterns. And even in the OECD countries, the picture there happens to be for the United States, but other OECD countries during the Great Recession, 2008, 2009, show essentially the same patterns, that very large, persistent shortfalls, scars, as the IMF now calls them, in output. So what we have established is that the COVID recession is a supply shock, first and foremost, and then followed by a demand shortfall. because of the consequences of the supply shock. Forecasts of the IMF, and I should say other international organizations, show a very sharp decline in growth, followed by a return in 2021. But then the level of GDP, as I just mentioned, is forecast to lie persistently for many years below the pre-COVID trend. Okay, so what needs to be done in this when we're facing this sort of problem? Well, policies, what do policies need to accomplish? Initially, they must be very targeted. First and foremost on the overburdened health sector, to make sure that it has enough resources to deal with those who are infected and become ill with this virus infection. Secondly, the policies need to be targeted to support unemployed workers, those who, for no fault of their own, have been locked out of work and unable to work because of closures of enterprises. This not only relieves immediate hardship, but it also is helpful once the economy starts moving again, because if individuals who become unemployed, if they have to run down their savings in order to buy food and other necessities, then even once they start being employed again, they will not consume and spend as much as they otherwise would, because they need to build up their assets and their savings. Secondly, policies need to support viable small and medium-term enterprises, the backbone of many economies. And this is to prevent what I call unwarranted bankruptcies, and I'll come back to the notion of unwarranted in a moment. And this will help to prevent those bankruptcies, will help once the lockdown and those types of policies are lifted, because then the firms can start producing again. If a firm goes bankrupt, it's much harder to start up again, because all sorts of relationships with banks, with other suppliers have been broken by the bankruptcy, and it's a much more difficult endeavor to pick up production again. Now, what do I mean by unwarranted bankruptcies? Well, the notion here is that every year, every month, there are some companies that go bankrupt, and because their business model was not good, maybe the management was not good, and so on. And those we want to allow such companies to go bankrupt. We don't want to prevent that, because then we will be supporting zombie firms, and the economy's growth rate will be much lower than it could be, because resources are tied up in unproductive firms. Now, these are the initial targeted policies. Later, when the lockdown restrictions are less of a problem, then more general stimulus policies, monetary policies and fiscal policies will certainly be useful until the economy has gotten back to a full employment-like growth path. So when we think about policies this way, then we can start thinking about what instruments should be used to achieve these goals, and which institution should be responsible. And that's where I eventually will get to the central bank. So which instruments should be used? Let me discuss this question using a little table, which has a time frame, to whom should the stimulus be given, how, and who should decide, and how should the financing be conducted. In the very immediate stage, where you want to support the health sector, that should be done with direct budget support, and the general government should be in charge. finance ministry or the appropriate ministry of the general government. In the what I call intermediate two, still in the situation where supply is constricted by various types of lockdown policies and restrictive policies, then, as I mentioned, affected workers need to be supported by cash transfers, maybe by tax cuts or rebates, transfers in kind in some where that might be appropriate. Again, this is a role of the general government to carry out these policies. Also, as I mentioned earlier, in this stage, the targeted support should be given to affected firms. That could be in the form of concessional loans. It could also be conditional cash transfers or tax reductions, similar fiscal policy measures, again, directed by the general government. There are other ways to help affected firms through financial means, and that, at least here in Malaysia, one measure that has been used is to mandate reductions in loan servicing obligations. The central bank has effectively told commercial banks that they should give extend loan servicing obligations into the future. And that is then effectively, it comes through the commercial banking system, but through central bank guidance. And finally, in the stage where there are lots of disruptions in the system, then central banks need to ensure smooth functioning of financial markets. That is done, and I'll come back to that in a moment, through asset purchase programs, liquidity support, loan guarantees. And that is typically done by the central bank. But there needs to be support from the government of these policies, essentially, in particular when they involve loan guarantees, because should these loan guarantees turn out to be needed, then funding for that needs to come from the government to the central bank and then to the firms involved. And then at the end, when or later on, when in the post-lockdown period, then if the recession still continues, then we can have more general policy stimulus to the public at large. Don't need to be so targeted. And that could be through tax cut, government spending, expansionary monetary policy. And the first two elements are, again, fiscal policy elements, and the third one is the monetary policy. Now, what I'm going to talk about mainly almost exclusively in the rest of this talk is this green area here, which involves some central bank involvement. Not in the tax cut and government spending, but the rest of them. And I will also want to talk about how these measures will be financed. I will say a little bit, not very extensively, some issues of that come about when the government issues debt to the private sector or to other institutions. And but I will focus mostly on the printing money, monetization of debt as a way of financing government spending or loan guarantees and so on. And when we can have a discussion of who ultimately pays when we use these different means of financing. That's the sort of the incidence of various forms of financing, which is a very interesting topic. Okay, so what have central banks done in the world? I'm not going to talk in any specific countries, and certainly not India, because one rule of speaking is that you don't speak about topics which audience knows more than you. So I will stick on to a fairly general propositions. So, of course, policy interest rates have been reduced almost everywhere. And there's a quote from a recent opinion piece by Gita Gopinath, the chief economist of the IMF, in the Financial Times, where she writes that 60% of the global economy, including 97% of advanced economies, central banks have pushed policy interest rates below 1%. And in 1/5 of the world, they are negative. I think those percentages, the 60, 97, and 1/5, refer to size adjusted. It's not number of countries, but you get the essence of the idea is that policy rates have been reduced. And because the recession was so much quicker to come about, the policy rates have been also reduced much more quickly in the current situation than they were in the 2008-9 recession. At least for the central banks you see here in advanced countries, it took about a year and a half to reduce interest rate to the minimum they were then, and whereas it took basically about a month to get them down close to zero in the current situation. So interest rates have been reduced very sharply. Now, but that's not it. That's not all. There have been asset purchase programs, liquidity support programs, and I call it an alphabet soup of these programs, because you see in that table, which comes from a BIS publication, you have all these letter combinations which show what these measures are, and I don't remember them all. That's not the important part I want to focus on here. If you're interested, they are in the references on the bottom of the page. But the point being, there are lots of lending operations that central banks have introduced, lots of asset purchase programs. There are also foreign exchange related programs, which are essentially swap lines between various central banks. So reduction in interest rate, asset purchase, and liquidity support programs. And the latter, the asset purchases, of course, imply very large increases in balance sheets of central banks. Here, from another BIS publication, you see the very sharp increase in and projected increases in balance sheets of the Federal Reserve, the ECB, Bank of Japan, Bank of England, and Bank of Canada. And other central banks have experienced similarly large increases in their balance sheets. And that, of course, has some implications, again, which I will come to later on. So, question, how should these measures, support of various kinds, be financed? Obviously, we're not going to finance government spending and cash transfer with taxes. That would be counterproductive. But governments can issue debt to the public. That may imply higher interest rates on the debt of the sovereigns, and that will translate in debt for increased borrowing costs for corporates. And also it has an implication that future generation will face higher taxes to pay for the interest payments and the principal when they come due in the future. And here's the interesting question: is there a burden on future generation of this debt? One could have a whole 2-hour discussion of that topic, but I just raise it here as something to think about. And I may, if there's time, comment on it a bit later on. Now, countries can also borrow, or some countries can borrow in international capital markets, but not all countries have access. In fact, probably the countries that have access, should they want to have it, are the advanced countries. Emerging markets have seen record outflows of capital rather than inflows to finance their expenditure in the current crisis. And of course, low-income countries they don't have much chance at all to get funding in international capital markets, which is why there have been lots of calls for subsidized or finance for these countries. Now, as I also mentioned, some of the financing may come through commercial banks, namely by central banks mandating extensions of credit to companies, and also extensions of debt servicing and so on and so forth. The possible consequences of that is greater non-performing loans, because banks lend to firms which otherwise would not have lent to. And then the question is, what will be the consequences of non-performing loans? Will bank shareholders have to pay? But the banks will argue that you, the central bank, you told us to lend, you have to bail us out. And then the losses will be socialized. And finally, this is what I'm going to talk about a bit later. The financing can come through printing of money, borrowing from the central bank. And the questions we need to think about there is whether that will lead to inflation, whether it will lead to currency depreciation, and what the consequences of that would be. And now I will turn to that. Will not mention very much or hardly anything about the topics up on top. You can discuss those later in the Q&A period. But I want to talk about printing money. And I want to do so in a particular way, namely whether helicopter money is the way to go. And I will argue that that may be a good idea in some countries, at least something that should be considered, but not every country should try it. And I will argue that it will not necessarily cause inflation. So, helicopter money, it's become very popular in the last half year. Very well-known authors such as Jordi Gali wrote an article which said, helicopter money, the time is now. Professor Gürkaniak and Professor Lucas, he is in Turkey, he used to be at the IMF, I believe, and Professor Lucas is at MIT. They have a similar proposal of funding pandemic relief by monetizing debt. I wrote a little blog some time ago where it's much, where I explain some of these issues. So what is helicopter money? Let me give you a brief history for those of you who aren't, who may not have thought about this for a while. It came from Milton Friedman, and he used it as a thought experiment to illustrate how monetary policy works. He said, assume we drop money from helicopters and people pick it up and spend. What are the consequences for prices and incomes and employment and so on and so forth? A thought experiment. But then Ben Bernanke, who then became called the helicopter Ben, he had a different sort of take on this and said, how do you stimulate an economy when interest rates are as low as they can be? Zero. Well, now they've gone negative, but not in the US yet. So how do you stimulate in that case? And he said, well, maybe we should think about helicopter money. And of course, now the issue is how do we transfer purchasing power to those in need most effectively, so they get it quickly. And again, that would suggest maybe dropping it from helicopter. Of course, that's only figuratively. But we need to understand, is this a monetary policy or is it something else? Well, if it's helicopter money in its sort of basic feature is the central bank prints cash hands it to individuals according to some rule, principle. That's easy to understand. Cash transfers from the government are similar, but in the sense that the government, the Treasury, gives T-bills to the central bank, gets cash back, and then gives the cash to the individuals. But now let's consolidate the public sector, and then what do we get? We get exactly the same as the helicopter money in the first row. It's a transfer from the consolidated public sector to individuals in form of cash. And that's important because if you want to think, and we will do that in a moment, think about the consequences for the central bank of engaging in operations which are very, very similar to fiscal operations. Will that be, is that a good idea? The funding proposal of Deborah Lucas and Refet Gürkanyak is similar to my last row. The Treasury gives bonds to commercial banks, and they credit the accounts of individuals by the exact value, and the bonds are given to the Fed, in this case the United States. They talk about the United States. The Fed buys the bonds and gives reserves to the banks. And then the Federal Reserve holds the bonds on its balance sheets in perpetuity. So that's their specific proposal on this. Now, not every country should engage in this sort of, should even contemplate this sort of debt monetization. Probably in the United States, it's maybe the least risk because it has a reserve currency. It doesn't need to worry about capital outflows in that sense and currency depreciation to the same extent as some other countries do. And also countries which have a credible inflation targeting central banks, they might try this, and even if it causes some inflation, the central bank will be able to reduce it in the future when need be. It's riskier for emerging markets because financial markets agents, when they see a central bank starting to monetize debt, they immediately think about inflation, they think about capital outflows, withdrawing their money, the exchange rate depreciates, and to the extent that the corporate sector holds a lot of their foreign liabilities in terms of foreign currency, that will cause hardships in the economy. And for low-income countries and countries with doubtful records of inflation control, I don't think that should be tried at all. Question: will debt monetization necessarily cause inflation? Some people who say no, it's not going to happen. They point to the QE, quantitative easing, during the great financial crisis, and say it didn't cause inflation in 2000, after the big expansion in the Fed balance sheets in 2008-9. So why should it cause inflation now? But this isn't the right analogy because the quantitative easing as practiced by the Fed was not debt monetization. It was just exchanging one type of debt for another type of debt. And it wasn't it's not a relevant analogy. And for further explanation of that, this paper by Gürkanyak and Lucas is a good reference. And then other people say, well, even if it did cause some inflation, central banks have the tools necessary to prevent it from exceeding inflation targets significantly once the economy starts picking up. And finally, many people argue that even if there is an increase, if it's a slight increase in inflation, that is a small price to pay for preventing a protracted recession and depression if we cannot finance appropriate government spending. Okay, the very last topic I want to talk about is one single slide, is some risks for central banks in doing what they have been doing. What, on the top there, you see what they have been doing. Some asset purchase programs, they direct credit to specific sectors in the economy. It's not like just buying treasury bills. They buy mortgage-backed securities. They buy, in the case of the United States, some corporate securities. And that is directed credit. And that is something that many people argue, if you're going to have directed credit programs, it should be done by treasuries and elected officials, not central banks. Helicopter money, as I tried to argue before, is effectively a fiscal transfer. And the same argument holds there. If it's a fiscal transfer, it should be carried out by treasuries. Again, similar argument about instructing commercial banks to lend to specific sectors, say the small and medium-term enterprises. It's another form of credit allocation and fiscal policy. So the question then is, should these type of policies not be the responsibility of finance ministries? Should they, instead of the central bank? And those who say it should be not carried out by the central bank point to potential risk. And one is a potential loss of independence. If finance ministers and the public at large start thinking that the central bank is effectively carrying out fiscal policy, then they say, well, in that case, we want to be part of the decision-making process. The finance ministry officials need to be part of the monetary policy committee, if that's what you're going to be doing. And in fact, a law under consideration in Indonesia goes exactly along those lines. There are also financial risks. If the central bank takes on credit risk from mortgages and other institutions, then there could be losses. And if there are such losses, a central bank will have to be recapitalized, and that raises the risk of loss of independence. There might also be a reputational risk and loss of confidence if whatever the central bank does leads to some losses due to credit risk and so on. And finally, there's a possibility that the central bank, by engaging in all these other programs, loses sight of the primary objective of monetary policy, which should be monetary stability and financial stability. So these are the issues I wanted to talk about. Sharan graciously allowed me to say 2 words about the exciting program we are setting up here at the Asia School of Business. I'm directing this Master of Central Banking program, which we will start in June of next year, and it's for central bankers, and it's about central banking. It's all about central banking. All aspects thereof, not just monetary policy, fiscal policy. It's about payments. It's about governance. It's about leadership. It's about challenges from fintech and so on and so forth. So this is an exciting program in a brand new building, the picture of which you see on the slide. But I want to finish there with, again, thanking you for listening. And I hope I haven't taken too much extra time from my allotted time. Thank you.
Thank you. Thank you, Professor Genberg. As I said, what I'm going to briefly, before I ask for questions or open it up, I would briefly say a few things. As some of our regular listeners know, that we've done a lot of work at EGROW Foundation on COVID-related matters, including the economics of lockdown and of COVID. So what I'll do is very briefly, much of what you said on the first part of your talk is similar, but I'm just going to highlight some of the differences, perhaps, which we, from an Indian perspective, and our analysis at EGROW have seen. And I'll just kind of restrict it to three major issues and just leave it there. One is that, of course, our analysis also showed very clearly that the pandemic differs because it's both a supply and demand shock. And basically, the way we saw it was the supply side is really when people get affected by the pandemic, when they get infected and get hospitalized, etc., it will kind of reduce the supply directly, one. Two, by disrupting supply chains, whether they are international or domestic. And on the demand side, it's more in terms of fear of contagion. And so one of the things we kind of analyzed is that clearly a rational person, will reduce, because of fear, a genuine fear of getting infected by a virus, which is still an unknown quantity, would avoid services which we call contact services. In India, we call them hospitality, travel, tourism, etc. But that would be the direct demand effect. And of course, there would be then follow from both demand and supply side. So that was one aspect where we had a slightly different or developed thing. The second aspect, second part of your introduction, where I would personally definitely differ with respect to India, and this comes in my third point, why that is so. But the growth part for India, which IMF has outline which you indicated, I disagree completely, at least with respect to India. And I think I do believe that the financial crisis is different from the pandemic. And financial crisis leaves an overhang of huge amount of debt. In this pandemic, we have kind of dealt with this debt issue very carefully, and I'll give an indication of that. That's my third point, third or fourth point. So I think in the case of India, the catch-up to the GDP level of the past is possible and will happen. And this relates to actually a little bit of my third point, which is the phases. I think by and large, your 2 or 3 phases which you mentioned for targeted policy are more or less identical to what we have called, what we have done. But in the third, or you call it third part or fourth, depending on the numbering one takes, is in a sense our objective is to re-accelerate growth. And the reason is very India specific, which was over the last 3 years or so before the pandemic, the growth had slowed. And we have a policy proposals which we believe will re-accelerate the growth. And so we should be able to catch up. I just want to mention this as some of the points which perhaps would be different for India. And finally, the fourth one is on the monetary credit policy. India has a large history of directed credit, which was done in a sense, was implemented to the central bank. But before I get to that, I think so we have a kind of more detailed approach. I would say it's not exactly directed monetary policy, but the policy which we adopted, which we recommended from our research, and which RBI has adopted, is really to make sure not just to injecting general liquidity and general reduction in policy rates, but to make sure that every significant set of institutions, whether it's banks, non-banking finance companies, and every significant market, whether it's the GSEC market or the commercial market or the market for SMEs or for household, that it has very carefully modulated, call it monetary policy, credit policy, to make sure that each of these markets and institutions have the liquidity. Now, as you very correctly mentioned, we are also well aware of the issue of liquidity versus risk. So what our approach has been for the monetary and fiscal policy to work very closely together, so that some things which are clearly risky, the government comes in and has done backup collateral backup. It is collateralized or given guarantees for proportions. For example, SMEs are seen to be more risky by the banks. So the government has combined with that to make sure that this part of the market keeps functioning, but with very careful design to make sure that the risks are not the moral hazard problem, so to say, that the risks are not increased by this intervention, but reduced and give an opportunity for the normal banking channels to operate. So these are kind of the three things which are slightly additional or different in our research. I just thought I'd mention them. And just before I open it up, I think your whole discussion was of monetization, etc., is definitely new. We've not really worked on it. So even from our limited perspective, that was fascinating for us. Now, with that, the participants, please feel free. Don't be constrained by my comments, because part of the objective of this is to see what has been happening in other countries. And I'm sure Professor Genberg has a much better view of that, because we've really focused more on India per se. And so I'll invite people to question and comment on the issues. Charan, is somebody, is there a hand function, or what are people, how do we, is somebody going to monitor who wants to ask questions?
Yeah. Yeah, requesting everybody to just raise your hand. We have that provision in our chat box, so we can ask, anybody wants to ask questions. And Professor Hans, I had a question for you, and this comes from our time together at the IU. One is this Schwetter-Saxena's paper that you have quoted in your earlier slides. The growth doesn't really catch up at all, and therefore it may start picking up, but the trajectory may be parallel, but it takes a long time before it can really match. Now, the three papers that you have quoted, I agree with you. I've also seen those papers, but my worry was, is there any empirical literature which can tell us that monetary policy and fiscal policy, if actively used, can help us to recover that loss in the initial loss, and the trajectory can become sharper at a later point? The second question I had was, now you see that when we got into this pandemic situation in the initial stages, we all thought it is about a 1 month or 2 month or a 3 month phenomena. And this has turned out to be nothing less than a Spanish flu 18-month phenomena, or maybe 2 years phenomena. So do you think, and you are actively involved at the IU in the growth projections, do you really think that 2021 will launch us into such high growth path and full recovery? We are already in November, and you see that the second lockdowns have started, and most of there is so much of stories on the US, Europe, that it may be very devastating. There is also the vaccine is not really here, and the festival seasons at different parts and Christmas time again. How much will be the precaution which people will take? So do you really think that 21 will end up with such high growth rates? That was my second question, please.
So, yeah, before you answer that question, I'll just, because Mr. Vigneshwara Swami has been raising his hand, let him answer the question, and then you are next, okay? Yeah. Professor, please go ahead.
Okay. Well, thank you for the comments of both of you. And I should say that, of course, the particular situation in a given country may, of course, lead to different outcomes. And I fully fully understand that in India, for various reasons, they might be different from Malaysia, from Europe, and so on and so forth. I do think the point you made about the fear of infection being a demand reduction, having a demand reduction effect, that is very important. I think many people forget and think that if infections come down, people will start spending. I think this fear factor is going to be a big drag on the economy. I will come back to the policies for catch up in just one moment. I want to also acknowledge that there's a big role for coordination between monetary and fiscal policy, that the fiscal authorities and the monetary authority must work together because of the issues that you brought up and the issues of financing where the central bank can be of help. But it must be done in a way that it maintains the primacy, I think, of fiscal decisions when it comes to allocating credit or giving specific sectors, and that can be carried out by the central bank with approval or from the fiscal authorities. Now, policies to catch up. So there is this literature I mentioned in that one slide it's a quite recent literature, and it argues that there are these so-called hysteresis effect of recessions. That is, for various reasons, because when people are laid off, firms go bankrupt. Those who are laid off, unemployed, they lose skills. Firms that go bankrupt, not because of their business model necessarily was bad, but the environment was bad. They lose their capital equipment is no longer useful, and therefore the productive capacity in the economy is lower. And that can drag on, I wouldn't say in perpetuity, but for a long time before those skills are picked up again, and investment in productive capital has increased. Now, according to that literature, what should be done? What is suggested in the last paper I show in that picture by Sweta Saxena, Valerie Serra, and Antonio Fatas, they say that there is an implication of that argument that monetary and fiscal policy should be overstimulating on average to prevent these recessions from happening. So it might lead to some more inflation, but that is less harmful than having these prolonged shortfalls of output. Again, this is there's some empirical evidence to that, but it's still ongoing research. And if you have, as you mentioned, you had proposals for economic policy in India, which sounded like they go along that direction. You have to have strong stimulative policies in recessions too, if you ever want to catch up.
So, before I ask Mr. Swami, no, actually ours is in long-term growth because of course, the fiscal monetary part is there, which was part of your talk, but we go beyond that to say that the crisis is also an opportunity for structural reform. So what we have talked about is more the structural reform we know, which we have been talking about last year or year before. So using this as an opportunity so that to avoid this trap, like exactly, I mean, I'm not saying this is not going to happen in other countries, but we have thought of policies which will try to ensure it doesn't happen with us. That's the point. Obviously, there's no 100% guarantee, but yeah. Okay, Mr. Swami, can somebody unmute or? Okay, yeah, go ahead.
Thank you, sir, for the opportunity to raise a point. Thank you, Professor Genberg, for your excellent presentation and very useful insights. My question is about, as you mentioned, and as we have also seen across the world, many of the advanced economies have seen expansionary monetary policy regimes. And in the process, some of the advanced economies are already in the negative interest rate regimes. So do you think that this negative interest rate will become the new normal in majority of the advanced economies in the days to come? And my subsequent question with regard to these developing economies, or rather emerging economies, where we are facing this tremendous fiscal deficit hikes because of this COVID stimulus programs and all. So in such a situation, in the years to come, whether are we going to face the problem of huge inflation? And in case if you go for monetizing the debt, then it will further add up to that situation. And how the central banks, given this present negative rate situations, can cope up with these kind of emerging scenarios. What are your thoughts on this?
Thank you. Very, very important questions. And like all important questions, they are difficult to answer. Negative interest rates, I think they're the so-called natural interest rate, or which is the real interest rate that would equate to savings and investment. That's one way of thinking about it, has been coming down for 20 years in these, well, worldwide, but most data are from advanced economies, but it's spread throughout the world. So it used to be 4%, it got down to 2%, and now it's close to 0. Some people say it's negative, the natural interest rate. And then, of course, if monetary policy does not want to be restrictive, the policy interest rate must be close to that. And the only other possibility would be to somehow get inflation up so that the negative normal interest rate I was talking about is the real rate. But if you have inflation of 3-4%, then maybe you can get the nominal interest rate up above 0. And then you have some policy room should you need to lower it somewhat. But then the question is, how do you get inflation up in this environment with very low interest rates? And there is this inflation puzzle that in many parts of the world that we don't understand why it is that inflation is so low. So I think it is here to stay for some time. I don't want to make prediction for more than a couple of years out, and I think it will stay that low for that period of time. Of course, there are those who say, well, if we could just go do away with cash, then there's no restriction on how deep nominal interest rate could go. Kenneth Rogoff has written about this in various books and papers. We're not going to get rid of cash anytime soon. Some countries like my own in Sweden, it's getting there, but in many other jurisdictions, it's far from demonetized in that sense. The other question was about inflation as a result of debt buildup. Now, of course, there might be inflation if that debt is somehow monetized through the central bank with various mechanisms. I think that is, or an alternative is that for emerging markets, open economies, small open economies in particular, the international capital markets will look at large debt in the country and say this is an unsafe place and pull money out. So there's a capital outflow and a currency depreciation, and you get inflation from the currency depreciation. Those are risks. I think in the current situation, those are risks we have to somehow live with, learn to live with, because the alternative of not providing stimulus is probably even worse. I don't know. It was an attempt to answer the question. I don't know if it's satisfactory.
Thank you. Yeah, is there other questions? Is anybody receiving? I have not received any hand up or.
Well, from my system, I can't put my hand up. My name is MP Besbarova. I just had one comment. Can I go ahead?
Yes, please.
Yeah. So one very interesting point I take from this discussion, which was made in the early part of Professor's presentation. Like he was talking about, I mean, in India, for instance, when you look at the packages, all the time we have been debating whether there should be, money should be directly put into the hands of people, or should we take other measures and so on and so forth. Even yesterday that was debated, and argument on one side is that, demand is low, so money should be put directly into the hands of people so that people can spend. The other argument is that in a situation of uncertainty and pandemic, even if you put money in the hands of people may not spend actually, and that's not going to serve the purpose. Now, what this professor has said is that if you don't put the money in the hands of the people, like he recommended it for the workers who have lost their job, what happens actually, they have to run down their savings now. So when the situations are supposed to be recovering, that time they'll have to raise their savings to recover their lost, sort of assets and all that. So what I'm trying to point out here, I mean, at least I've got a point in India, I think it's not being debated. So if you don't put the money now, you don't know whether the demands are going to be raised or not. But at the same time, if people have to run down all their resources, as we start recovering, again, the demand may be very adversely affected because people will be rather saving than spending. I think this is a very important point. I think the debate get further extended.
Right. So,
Right.
So, Professor, as you and we also have been saying, maybe you can elaborate the targeting. You mentioned the word targeting. We have been doing the same. So, perhaps you can elaborate a little to clarify to Ms. Barua on the issue of that approach, targeted approach to policy.
You mean me?
Yes, please.
Oh, I see. Okay. Well, excuse me. Well, essentially, the idea is that some parts of society are feeling hardship. I happen to be an academic, and I keep my job and I keep my salary. So there's absolutely no reason why I should receive any support of a general form. There are lots of people in the restaurant business, in workers in factories, who lose their salaries and wherewithal, and they should be the ones who receive it. Now, in principle, of course, that is easy to say. How do you carry it out? That is more difficult. And I have been reminded here in Malaysia. I said, well, why can't we look at tax payments that are being automatically taken from salaries and so on? If that does not come in, that a person doesn't get any salary, so then we can give subsidies. I was reminded that a large proportion of the poor people here don't pay taxes, so that doesn't work. You have to find other ways of identifying people who are needy in that sense. But that's my point.
Absolutely. So the issue really is that both professors' work and our work shows that the best thing for a developing country like India would be to target it. And as he said, the key issue is how to do that. And so the approach adopted by the government, which is consistent with what our research suggested, is that you feel, there's the old Chinese proverb about feeling the stones while crossing the river. So that has really been the approach to try and see which parts of the economy or which part of labor force, etc., has been most affected, and then to see what can be done about it. Now, clearly it's not perfect, but the idea has been that it evolves, that we learn as we go along. And why that? Because there is no cookie cutter. This is a pandemic is a once in a century thing. even the knowledge about the way it spreads, etc., has gradually accumulated. So to think that we know everything about its economic effects was very presumptuous. I actually still remember listening to the best economists in the world from all over, and everybody said that we don't know what's going to happen, but then somebody said, okay, what do your guess is? We were all guessing for several months, 2, 3, 4 months. Of course, now we have a little more knowledge, etc. So that was the approach. I mean, I'm sure you can find weaknesses in it, etc., but that's been the approach of the government.
May I ask a question related to that in the context of India, but it's applicable to other countries as well. India has a very large informal sector, I understand, correct? And how do you deal with that in this sort of targeted policies? Because they're very much affected, correct?
Yeah. So initially there were there are 3 welfare programs which were directed at the poorest, and they were greatly expanded. Let me just list them. One of them was the free food program. So the government hugely expanded that program and extended it and expanded it so that a person who uncooked food, you get the ration. So one was that directly people who are affected, they are used to going to the ration shop. They can go and get more food so that they don't starve, right? The second was there were something called Manrega. It's an employment program for the poorest who can't find a job. But this operated only in rural areas. So that was expanded. And again, people may criticize that not enough, etc. But that was a useful channel. There were certain elements of cash transfers, but the biggest weakness we have seen, which was kind of missed in the beginning, is urban unemployment, but not just urban. Migrants from rural areas to urban who got out of a job when this pandemic, lockdown, etc., there was a lot of confusion initially, and who got stuck in the middle, who then started going back home and, in that confusion. And so now the effort is to maybe get them back into their jobs. So a couple of things were announced yesterday and so on. So this particular part is relatively new. It was not conceived right in the beginning, and then it happened, and then we've been scrambling to find ways of reaching these people. Of course, if they got to the rural area, they could join the Manrega program, right? But it was in the middle, some of them are caught and so on. So there were existing channels, to summarize, which were expanded and etc., including some cash transfer schemes, etc. That's how it was done to reach the poorest. Then, of course, bankruptcy in firms is a different issue.
Right.
I would like to supplement what Dr. Virmani said. The government came out with a program for the hawkers, and the banks were used to give loans, small amount ticket loans to through Mudra schemes. So what Dr. Virmani is saying is, initially in 2014, we did not have sufficient people. We did not have people having bank accounts who are in the informal sector, and the government started that they all should have a bank account. So that benefit transfers also started through those bank accounts. So as Dr. Virmani is saying, the government adopted various ways. No single way was complete. Government adopted various ways to reach this segment of the population, which is in the informal sector. Now, I would like to mention there are 2 hands which are raised, and Dr. Virmani will decide who speaks.
Okay.
Mr. Vinay Gupta, and one is Mr. Tripathi.
I thought there was Professor Subramaniam was doing. Okay, yes. So let us take them in that order. Let's take them in the same order.
You are right. Professor Subramaniam has also raised his hand.
Yeah, so let's start with him because I think I saw him a bit earlier.
Sure.
So, Professor.
Good evening, Doctor.
Yeah.
Am I audible?
Yes.
Thank you. No, Professor Genberg has beautifully explained the various situations in different countries and with the stage of advanced economies in various parts of the world. And then the way he has mentioned about in India, that is our developing countries, I feel he has correctly targeted and then advise very clearly the type of programs we should undertake. I feel in India, both central bank and government together, they have worked together especially during this period, to synchronize fiscal policy with the monetary policy. I feel that has quite worked well. And then, do you feel this can definitely take the country out, and then by 21 or 22, whether India can move forward? Thank you very much.
There are so many experts on India in this gathering, so I hesitate to take a stand on that. But certainly, the idea of coordinating fiscal and monetary responses is an important part. And I leave it at that, and Dr. Virmani will help me out.
Yeah. Sorry, what? Yeah. Sorry, I had to just go to the toilet. Yeah, what? I missed the last part. What is it?
So, will economic policies, if I understood the question correctly, in India be able to bring India's economy back to the sort of growth trajectory that it would have had absent the COVID crisis?
So that's a question to me. I can tell you we've had one we are going to have another talk on the 18th. Dr. Singh, yeah. So you can join and have a detailed answer why. I've given one talk before, which focused less on the growth part, which is also on our website. But if you're really interested in that question, I'll be addressing it more fully in that talk on the 18th. Probably at 5:30. No, it is at 2:45. Oh, okay. But that is to an audience, and then we'll put it on the website. So we'll let you know. But the previous one is there. Dr. Singh, where is the previous talk? How to restore the growth?
Yeah, it is on our website.
Right.
Subramaniam, it's on our website, and I can send you the link. It is Dr. Virmani started this Friday webinar series, and his was the first talk in that context. So I can send you the link.
But I address the reform issue later. So yeah, you can look at both the talks, but we'll have a third one up later. Let's take the other two questioners who were mentioned. You finished with the rest of his question, I presume. Yeah. Dr. Charan Singh, Vinay Gupta. Okay, go ahead.
Yeah. So my question is for Mr. Dr. Virmani. This is because it's for India in specific.
Okay.
Like other countries as well, India has also lowered interest rates quite a bit, even though we are nowhere close to zero. But India is different from other countries in the sense that in India, the inflation, particularly the retail inflation, is very high. Now, in this situation, effectively the interest rates are negative interest rate. Now, when the interest rates are low, the beneficiaries are borrowers, the beneficiaries are banks, because banks' treasury incomes go up, and probably government also, because government's cost of borrowing also goes up. However, once particular stakeholder group, which is the depositor, they lose out very badly, particularly in a situation where the interest rate is very high and inflation is very high and effectively leading to negative interest rate. Now, this can go on for a short period of time, but over a longer period of time, it's going to hurt because people will probably start keeping less and less deposits in the bank, and they might go on for riskier investments, and they may not be very familiar with it. So is there any policy prescription or something where we can protect the interest of the depositor also in some way?
No, I think the issue is really a question of why the inflation is high in India at this time. And basically, what our research had suggested was during this transition from lockdown to normalization, where I define normalization as a state where the GDP is equal to, if you take a month, equal to year on year GDP is roughly as it was a year ago. So that transition period, what we had our analysis showed, was likely to result in fragmentation of markets and appearance of demand-supply imbalance, which could go either way. Not a clear aggregate excess supply or excess demand situation, and fragmentation of markets and logistics problem. So that is exactly what has happened. What is a little surprising is that this logistics problem seems to be affecting the essential commodities, the agriculture, food and agricultural sector more than we, when we did the research, had anticipated. But the empirical work which RBI has done actually 100% supports us. It's surprising, as I told them. What they found was that 90% of this increase in inflation is due to supply side factors. Their independent research, they were not committed to my paper, but this is what they found. So if that is true, we have to really, it's not a demand issue, it's a supply. So we have to make sure those logistics problems are solved as quickly as possible, and then we would expect the inflation to come down. So it is a matter of a short time. Perhaps the government, because it's not, remember, we have 29 states and UTs. So center cannot wave a wand. Action has to take place in the states. So where there are bottlenecks in the state level in the supply chains, they have to clear them up. And this is not something I'm saying now. We have been warning about this on so many interviews I've given. So I'm still hopeful that within a couple of months or so, these logistic problems will get sorted out and we will see a sharp decline to a more reasonable level, which is what we all want. Yeah.
Thank you.
Related to this, Professor Genberg, we had one issue. I had one thought. The Fed Reserve continued with its accommodative policy, interest rate policy, which, as you know, is from 0 to 2.5%. Whereas there are a couple of countries which are in the negative interest rate zone. And I was wondering, do you think, can America go into the negative interest rate zone given the situation? What would be your take on this thought?
The Federal Reserve authorities, they are not very keen on negative interest rates. So they have taken the approach of doing quantitative easing, asset purchases, and trying to stimulate the economy that way. And essentially by trying to force down longer term interest rates. And I suppose also to some extent corporate bond rates, which tend to be longer duration. So before the Federal Reserve will have negative federal funds rates, I think they will pursue their policy of quantitative easing and asset purchases very aggressively. And also, they try very hard also by sort of forward guidance suggesting that the interest rates will be low and inflation rate will come up and so on. This is it's a strategy that doesn't seem to have a great deal of success, but I think they will persist in that for quite some time.
Okay, the next gentleman. Let's take the next question.
This is Mr.
You had mentioned, Charan, who was the person?
Mr. Tripathi.
Tripathi, yeah. Mr. Tripathi.
Yeah, good evening,
Yeah.
Professor Genberg.
Yeah.
Sir, I have two questions for you. First, I wanted to take your views. What impact the change of guard in United States will have on the global economy? how his election is being received by the European countries and European economists, and whether it will be positive for the economic growth. And second question I will follow up question I will ask later.
No, you have to ask both questions right now.
Okay, fair enough, sir. My question, what is Professor Genberg's view about the 1 to 2 year long-term inflation and growth for my country, India, and for the world as a whole?
Okay,
Inflation
thank
and
you.
growth rate.
Thank you. Professor Genberg,
yes.
just take whatever you can answer, yeah. Whatever.
Yes, I will focus mostly on the first
Sure.
question. I think, first of all, hopefully there will be a transition. This is said somewhat ironically, given the way things are going in the United States, but of course it will be eventually. And I think that will have positive effects on the global economy, because I think the Biden administration will be less confrontational. And I think that will be positive for international trade, and international trade is an important driver of economic growth in the world. I think also the Biden administration, at least it's going to try to put through more stimulus measures in the United States. I think stimulus measures in the United States are needed as long as unemployment is exceptionally high, which it is for the time being. Now, the problem there is, of course, stimulus measures, fiscal stimulus measures are going to require the approval of going to have to pass through the Senate. And to the extent that the Senate will, if the Senate will be still controlled by the Republicans, then that it will be a difficult process to try to put together these policies and make them effective. But overall, I believe that the stability and the sort of the international. Well, the stability of the Biden administration that it will bring to international relations will be a positive effect on the global economy. I will again defer and refrain from making predictions about the Indian economy, because it's not an economy which I regularly study. Of course, I am interested in what happens. It's a huge economy, an important economy, but I don't know enough about it to have an opinion, I'm afraid.
Thank you.
What about the global growth and global inflation?
Global growth, I think it will be positive. The Biden administration will be positive for economic growth in the world. And I don't want to give a number because those growth numbers, I think, as Dr. Vimani suggested a little bit earlier, but in a different context, we're still kind of guessing what the outcome will truly be. And also, as Dr. Singh said, we are subject to reversals due to a second wave or a third wave of the virus, and the somewhat uncertain effects of the virus. I mean, of vaccines, which if we truly have effective vaccines, and if they can be distributed in large enough scale, that might will, I think, also certainly have a positive effect, because it will reduce the kind of fear of infection problem that Dr. Remani suggested in his first comments, that it's a drag on economic growth.
Okay, thank you, Dr. Singh, Charan Singh. We are at 7. I don't know if there's any pending question. If there is, we can take one, but otherwise, maybe you can conclude.
I think we will conclude, because it's already 7 and I spent 90 minutes talking on this. So with this, I must thank Dr. Virmani for chairing the session and Professor Hans Genberg for delivering such a scintillating talk, which I thought was very interesting. His PowerPoints, if you would like to share with us, we will place it along with this recording on our website.
I can do that.
Yeah, and that recording will be available tomorrow about noon onwards. You can share the recording with anyone, and everybody can then have the benefit of it. There is one question which has come up, which I think Dr. Virmani and me in some way have already answered. And the overall picture was already given by Professor Hans Genberg. And the question is, what is your opinion with regard to steps taken by Government of India to stimulate economy? So that was the question, and I think me and Dr. Virmani at length, and I supplemented his answer. And Professor Hans Genberg has already said that there are ways that you can stimulate the economy. Even at the fag end of his observation, when he said America is trying, without getting into negative interest rates, America is trying to get out of this whole thing and get into the growth process through the asset purchases. So yes, my own gut feeling is in India, the government stimulate package is working. They're coming in different stages, but yes, they're working. Dr. Virmani, would you like to any observation?
Yeah. So the key point we had made from the start in the Foundation for Economic Growth, our research was right from the beginning. We said from May, June, when we started the research, that a generalized fiscal stimulus was not the way to go in a pandemic and the lockdown, because we had 60% lockdown, probably one of the strictest lockdown in the world for about 6 weeks. So in that kind of situation, a general stimulus is a waste of money. And we explained, we have a policy paper explaining exactly why that is so. So in that sense, the government, I don't know, maybe Dr. Singh can tell you whether they've been reading our papers or not from our website, but they have more or less followed the broad approach which we had outlined over the, in a series of papers. I think we've done 3-4 papers on the economics of it. We've done 2 or 3 papers on the pandemic per se. And so, yes. So my answer is yes. We think the government has done a good job because they are doing what we have recommended. It'll be kind of funny of me to criticize them for doing what we have recommended. But that's not the only reason, because I think our views are now, you heard from Professor Genberg, which are broadly similar to what we have been saying, with variations arising from the Indian situation a little bit. So yes, I think they are doing a good job. So with that, I think I also would like to thank Professor Charan Singh for organizing the thing for EGROW, and Professor Hans Genberg from joining us and giving us an opportunity to hear him and questioning. So thank you, everybody, and our audience, of course. Thank you.
Thank you very much.
I would like to make one announcement. Next Friday, same time, we have Dr. Prakash Lonjani from the IMF, International Monetary Fund in Washington, speaking to us on income inequalities. He has a paper, and which he'll be then discussing that paper on our forum. I would request all of you to please pencil in your diaries and join us next Friday. And let me once again thank everybody, thank Dr. Virmani as well as Professor Hansberg for this lovely interaction today evening. Thank you.
Thank you very much. Thank you.
Thanks a lot.
And happy Diwali if that is in India as well.
Thank you. Thank you.